India Accounting Standards first time adaptation of NDAs. After studying chapter, you will be able to understand the objective of the issuing of standards and appreciate the applicability of non-applicability of standards. Define the relevant terms of first NDAs, financial statement, the first time adopters, opening NDAs, balance sheet, date of transaction of NDAs, first time NDAs reporting, deemed cost and previous gap, applying the recognition of a measurement principles and preparation of opening NDAs balances, evaluate the mandatory exemption in which NDAs prohibits retrospective application of NDAs. Examine when NDAs 101 granting voluntary exemption from some specific requirement of NDAs, knowing the carves out of NDAs 101 IFRS. Chapter review, scope of objective, definition, recognition, measurement, presentation, disclosure. Opening of NDAs balance sheet, accounting balances, exemption to retrospective application to other NDAs, exemption for other NDAs. Introduction. The NDAs 101 prescribe the accounting principles of first time adoption NDAs, lays down the transaction requirement when the companies adopt NDAs for first time and moves to financial standards of NDAs. Concept of accounting under the NDA should be applied retrospectively at the time of transaction of NDAs. However, NDAs 101 grants a limited exception when those requirements specified areas where the cost of accommodation with them would be likely to exceed the benefit users of financial statement. NDAs 101 also prohibits retrospective application of NDAs in some areas called exemptions, particularly when the retrospective application would remain judgment by the management the past condition after the outcome of particular transactions in already known. NDAs 101 above prescription prescribes presentation and disclosure requirement to explain the transaction to the user of financial statement, including explaining how the transaction of NDAs to NDAs affect the company's financial position and financial performance of cash flow. NDAs 101 does not provide any exemption for the disclosure requirement of NDAs. Objective. The objective of NDAs is to ensure that the entity's first NDAs financial statement and interim financial reporting is part of the period covered by the financial statement and contains high quality of information that transparent to the users of comparability, provides suitable starting point and the cost transparent to the user comparable and providing suitable starting point and the cost that shall not exceed the benefit. The definition. The first NDA is financial statement. The annual financial statements in which entities adopt NDAs and explicit unreserved statements and complaints with NDAs. The means complaints of all NDAs, partially complaints is not enough to make the NDAs complaint. First time adopters. The entity present the first time NDAs and entity is known as first time adopters. Opening NDAs balance sheet. The entity's balance sheet at the date of transaction NDAs. A date of transaction of NDAs the beginning of the earliest period on which entity presents the full comprehensive information under the NDAs 16 and the first time NDAs financial statement. Illustration. Accelerated required to adopt NDAs April and comprehensive to 1 year, that is what is the date of transaction? The date of transaction actually 1st April of the being the beginning of the earliest comparable presented. They explain it further. Accelerated is required to adopt the NDAs from 1st April and it will be for the previous year. And it will be compared with the as per the NDAs for the 2021. So previous accordingly the beginning of the comparative will be the previous year will be considered as a data transition. First NDAs reporting period. The latest reporting period covers the introduced NDAs and statement. Example XYZ Limited is a BSE Limited company having net worth of 100 crores. XYZ Limited has a prepared financial statement for the NDAs for the April 2021. The first NDA's financial limited would be the period ending of the next year. The first time adopter will be 1st April 21. The opening NDAs will be 1st April 20. The date of transition from 1st April 20 to first transition of NDAs 1st April 20. First time NDAs reporting is 1st April 21-22. The financial year of the period from 1st April 20 to 31st will be comparative period of the first NDAs period. Deemed cost. The deemed amount of cost as surrogate the cost and depreciation cost in given period. The subsequent depreciation or amortization assume that the entity has initially recognized asset as a liability at the given date and the cost was equal and deemed cost. The definition was used to measure at the date of transition of 1st April as first announcement here. Investment subsidiaries, joint venture associate, property, plant, equipment, or an investment property, an intangible asset, or right of use asset. Asset acquired and liability assume the business combination when the exemption of Ind AS 101 is available. Gap, gap GAP. The basis of the accounting is first time adopter used with the statutory reporting requirement in India immediately before the adoption of NDAs. For instance, the company required to prepare the financial statement according to one section 133 of the Companies Act shall consider the financial reporting previous GAAP financial statement when the GAAP or financial statements are prepared as per the company's accounting policy rules 2016 and hence accounting standards are previous year's GAAP for the companies in India. Company being the foreign subsidiary of Company A and has adopted IFRS and is issued by the IASB, the primary gap in the local financial reporting purpose. Company B proposes financial statements as per the accounting standard specified in the 133 of the Company 13 right with the rules of the Companies Act of the purpose of consolidated companies. On transition of Company A to NDAs, it will be previous gap of the foreign subsidiary Company B for the financial statement prepared and consolidated with the Company A. Solution: NDAs 101 defines previous gap as a basis of account and first time adopters using statutory reporting requirement emphasis immediately before the adoption of NDAs. For instance, the company prepared its financial statement in accordance with the accounting statements respective under the section 133 of Companies Act 2013. Read with the rule 7 of Companies Act 2000 shall consider this financial statement as previous gap financial statements. According to the provision of the GAAP of foreign subsidiaries, purpose of consolidated NDAs for the present company would be accounting standard specified under the 133 of Companies Act 2013. Right with the Rule 7 of the Companies and Rules 2014, not IFRS issued by the ISB since the first time adoption was considered to be content of India only. Scope: the NDAs 101 applies at first NDAs Indian financial statement. Each interim financial report of this part of period covered with the first NDAs financial statement. For example, the period covered the first NDAs is 31st March. Then the company prepares quarterly financial statement, interim financial statement for each quarter of the year. NDAs 101 shall be applied preparing this financial statement. However, it could not does not apply the changes of the accounting policy made by the entity that already applies in NDAs. Illustration: E Limited is acquired to first time adoption of NDAs and 1st April. The management of E Limited has prepared the financial statement in accordance with the NDAs. An explicit unreserved statement of complaints in NDAs has been prepared by the management. However, there is a disagreement in the applicable of one NDAs between the management auditors. One can the financial statement of E Limited treated as a first time NDAs. NDAs 101 defines that first time NDA statement, that first time annual financial statement, and the entity adopts NDAs by the explicit and unreserved statement of complaints with NDAs. According to the above definition, if an explicit and unreserved statement of complaints with NDAs has been given in a financial statement, even if the auditor report contains qualification because of the disagreement and application of NDAs, it would be considered that E Limited has done the first time adoption of NDAs, and the cascade exemption given under the 101 cannot be available again. If however the unreserved statement is complaint is not given to the financial statement, such financial statement should not be considered as a first time adopted financial statement. Recognition and measurement. Opening of NDAs balance sheet. The balance sheet prepared and presented in opening a balance sheet of the data transition of the NDAs. This is a starting point of the accounting in accordance with the NDAs. Accounting period. Entity uses the same accounting policy in opening of NDAs balance sheet, and thus all the period presented in the first NDAs financial statement. The accounting policy shall be complied with each NDAs effective at the end of the first NDAs reporting period, subject to mandatory exemption and optional exemption. Example 1 of consistent applicability of latest version of NDAs. The end of entity A first NDAs reporting 31st March 2022. Entity A decides to present the comparative information to those financial statement for 1 year. Therefore, the date of transition of NDAs beginning from 1st April 2020 for the equivalent close of March 31st 20 April to March business on that March 2020. Entity A is presented financial statements accordance with the provision of GAAP annually to 31st March ended up to the including 31st March 2021. Application of requirement entity A user required to apply NDAs. NDAs applicable to period ending 31st March 2022. In preparing presentation in opening NDAs balance sheet April 2020 and preparing presenting balance sheet of 31st March including comparative amounts of the year 31st March, statement of profit and loss statement, changes in the equity and changes in cash flow in the year of 31st March including comparative amount of the year 31st March and discloses including comprehensive information of the year 31st March. If a new NDA is not yet mandatory but permitted, yearly application into DA is permitted but not required. Is apply of NDAs in the first NDA is applicable. General principle of NDAs 101. It may be noted that the way NDAs 101 structure the first lay down the general principle that the NDA is effective on the first NDA's reporting period and shall be applied retrospectively. That is in the starting point. It would be opening NDA's balance sheet and should carry the businesses as if the NDA has always been updated in the company in the past. One is the general principle has been specified NDAs 101. Then talk about the certain exemption and the exemption that formally would voluntarily and it take later be mandatory as mentioned above. Now let's talk about the general principle first. The entity shall in the opening of NDA's balance sheet recognizing all the assets and liabilities with recognizing recovered by the NDAs. For example, recognizing derivative assets and liabilities for which different guidance was followed under the Indian GAAP. Intangible assets arising in Indian combination which may not be carried on the books of the acquiring entity under the Indian GAAP. Non-recognizing items, assets and liability of NDAs do not permit such recognition. For example, NDAs 115 the revenue from contracts and customs for different threshold for revenue recognition as compared to the NDAs 9 AS 9 under the Indian GAAP. And when such an item that is recognized as a trade receivable in Indian GAAP may not be recognized on the NDAs. The reclassified item that is recognized in the accordance with the GAAP as one type of asset and liability in the as a component of equity, but different type of asset liability and component of equity in accordance with NDAs. For example, NDAs require classification of assets given on operating lease as an investment plan, whereas the same is presented in the property equipment GAAP. Applying NDAs measure all the recognized assets and liability. For example, NDAs has well-defined measure principles and financial assets and liability in certain investment measure the fair value of NDAs, whereas the same is measured lower the cost of fair value under GAAP. Exemption. There is a two category of provisions of NDAs 101 under the general principle mentioned above applied in the modified manner. The mandatory exemption to the retrospective applied in the other NDAs. An optional exemption in the retrospective applicable other than NDAs. Mandatory exemption to the retrospective application to other NDAs. Estimate the entity estimates according to the NDAs at the date of transaction. NDA shall be consistent with the estimate made for the same date in accordance with previous GAAP. After the adjustment is reflected on the difference of accounting policy. And there is an operating evidence that there is estimate is error. Estimate derived by the previous GAAP. If yes, then go to step 2. And the evidence is error. If yes goes to step 3, step would make the estimate reflecting condition of relevant date as a date of estimate relevant. Estimate relates and consistent with the NDAs. If yes goes to step 5 and step 5, use previous estimate. If the use previous estimate adjust to reflect NDAs. Estimate required by previous GAAP makes estimate reflect a condition of relevant date. If yes estimate is error, yes makes estimate reflecting conditions of relevant date. If no consistent with NDAs, yes use previous estimate. No, use previous estimate and adjust to reflect to NDAs. Derecognition of financial assets and liability. The first time adopted shall apply the derecognition requirement of NDAs 109 prospectively for transaction occurred on or after the date of transaction of NDAs 9. Example, the first time adopted derecognition of non-derivative financial assets or non-derivative financial assets accordance with the previous GAAP result of transaction that has occurred before the date of transaction of NDAs. It shall not recognize those assets and liabilities according to NDAs 9 unless qualifying for recognition and result of the later later transaction events. A practical example, such a financial asset shall be scrutinized for the loan portfolio of NBFC to trust before the date of transmission, resulting in derecognition of the same from the books of the Indian GAAP. However, such NDA's derecognition criteria may not have been met. Given may apply the recognition requirement NDAs 109 retrospectively from the date of the entity's choosing, providing that the information needed to apply the NDAs 109 to the financial asset and financial liability re-recognition as a result of the past transaction were obtained at the time of initial accounting of this transaction. Hedge accounting at the end of date of transaction of NDAs or NDAs entity shall measure all the derivatives at the fair value, eliminate the derivative losses and gains arising in the derivatives that is reported in accordance with the previous GAAP as if they were assets and liabilities. The entity shall not reflect the opening NDA's balance sheet and hedging relationship as a type does not qualify the hedging accounting according to NDAs 109. For example, may hedging relationship where the hedging instrument is standalone written options are not return option where the hedged items and net position or cash flow hedging on another less than foreign currencies. Another affords its hedging relationship. It is a type of qualifies of hedging accounting. A hedging relationship consists of eligible hedging instruments and eligible hedging items in S 109 and designated under Indian GAAP. The hedging relationship is required to be reflected in the opening NDAs because balance sheet, respective whether the conditions of applying hedging accounting that is a document of respective. If the conditions are not met required by the NDAs 109 respective, the discontinue of hedging accounting apply subsequently. As a corollary of this principle, if either A and B above are not met, bearing a specific exemption. Later subsequent paragraph, the hedging relationship is required to be removed from the opening of NDA's balance sheet. If the entity designed to net position of large hedging items in accordance with the previous GAAP would not be qualifying hedges item, otherwise NDAs 109 it may be designated as the hedge item according to the NDA's individual item within the net position as a net position of met and requirement of NDAs 109, providing that it is not later than the date of transaction NDAs 9. Hedging accounting is followed only from the date of qualifying the criteria met. Irrespective of the condition related to A, B, and above, and transaction entered into before the date of transaction in NDAs 9 shall not retrospectively design to hedging. Non-controlling interest first time adopter shall apply the following recommended NDAs 109 retrospectively from the date of transaction of NDAs. Total comprehensive income is attributable to the owners of the parent and the non-controlling interest. Even the result of non-controlling interest have a deficit balance. The accounting of change in the parent owner's interest and subsidiaries that do not result in loss in control. The accounting of loss of control over subsidiary and the related requirement of NDAs 105 non-current asset held for sale and discontinued operation that is classified as the asset and liabilities of subsidiary and held for sale. However, the first time adoption affects the apply of NDAs 103 retrospectively the past business combination and they have not apply NDAs from the that day. NDAs requires allocation of the losses to the non-controlling interest, which may ultimately lead to debit balances non-controlling interest, even there is a no contrary with the non-controlling interest of holders of contributory asset and companies to fund the losses, where the adjustment is required to be permitted in the case of retrospectively solution. In the case of entity elects does not in the case of entity elects or not to reset past business combination in DS 1 requires the measurement of non-controlling interest. The follow from the management for the assets and liability for transaction in DS. However, NDAs 101 contains mandatory exemptions that prohibits retrospective allocation of accumulated profits between the owners of of the parent and NCI. In the case of entities elect not to restate the past businesses combination provision, gap carries out NCI not charged other than the suggested made. Measurement of the assets and liability subsequent to the business of combination as a result of the transition of NDAs. As a result of carrying value of NCI in the opening of NDAs balance sheet carrying where the deficit balance is on account of recognition loss attributed to non-controlling interest which is not recognized under the deficit cap as part of NCA in absence of contrary to contribute assets and fund of deficit. However, the NCA could have deficit balance due to the remeasurement of assets and liability subsequent to the business combination a part of transition of NDAs. In the case of entities a restated past present business combination, NDAs 101 requires a balance sheet as the date of transition shall be determined retrospectively in accordance with the NDAs, taking into account the impact of the other election part and part of adaptation of NDAs. As per the NCA would have deficit balances on the accounts of loss attributed to NCA, even there is no obligation of the holders of NCA to contribute assets in the fund which is deficit. Classifying them. Classification of measure of financial instrument. NDAs 101 contains principles of classifying financial assets at the amortized cost, the fair value through other comprehensive income, and the fair value through profit and loss. Such classification depends on the assessment of fair value of asset date of initial recognition. The NDAs 101 provides exemption to the general public to require that the assessment should be done the date of transaction of NDAs. NDAs 101 further provides that if the impactable to assess the below mentioned further assessment financial asset as the date of transaction of NDAs, the contractual cash flow characteristics would be done without taking into the account of further modified date of time of value of money elements, significant of fair value of repayment features. The entity shall disclose the carrying amount as a financial asset until these financial assets are derecognized. NDAs 109 requires that measurement amortized cost of financial asset as a financial liability using effective interest method. As an exemption to the general measurement principle, NDAs 109 provides that if the impactable asset defined on NDAs 108 on NDAs 8 or the entities applying retrospectively the effective interest method, NDAs 109 is a fair value of financial asset, financial liability. The date of transaction of NDAs shall be the new gross carrying amount of NDAs asset and new amortized cost of financial liability, the date of transaction of NDAs. Impairment of financial asset. The entity shall apply the impairmental further to NDAs 100 retrospective subject to the below. At the date of transmission of NDAs, the entity shall use retrospective reasonable supporting information that is available without the undue cost and efforts of determining the credit risk at the date of financial instrument and initially recognized. The entity shall not require to undertake the exhaustive search of information by determining the date of transition of NDAs whether there has been significant increase in credit risk since the initial recognition. If at the date of transition of NDAs determine whether there has been significant increase in credit risk since the initial recognition of the initial statement, it would undo the cost and effort. The entity shall recognize the loss of allowance and the amount equal to lifetime expected credit losses at the reporting date until the financial instruments are derecognized unless the financial instruments are low credit and reporting date. Importing derivatives. The first time adopters that assess whether the imported derivatives are required to be spread from the host contract to accountant for the derivative on the basis of condition that exists and the later year date of first becoming party of the contract and date of assessment of the required by NDAs 109. That is when there is a change in the terms of contract and significant modifies the cash flow that otherwise would be required under the control. Government loans. The first time adopter shall classify all government loans received by the financial liability as an equity instrument in accordance with India's 32 financial instrument presentation. The first time adopter shall also apply the recommend of India's 110. The financial instrument that India's 20 accounting for government grants and disclosure of government assistance respectively to government loan existing to the date of transaction NDA shall be not recognized corresponding benefit of the government loan to the below the market rate interest of the government grant. Example for government grant of India provide MSME the market below rate of interest to fund the startup of new manufacturing facility. The company of date of transaction of India is equal. The India company A has received a loan of 1 crore the below market rate and the interest from the government under the gap and the company is accordance with the loan that the equity and the carrying of 1 crore the date of transaction account prepayable 31st month 1.25 crores. And then the loan means the definition of financial liability according to NDAs. Companies assert that they clarify the equity and liability. It is used to previous gap carrying amount of loans at the date of transaction and the carrying amount of loan in the operation NDAs balance sheet. It classifies the amount actually affected rate of return starting from first April, and the amount of is 1.125 of 1 by 1, that is 5.4 by approximately amount by principal to 1 by t. It's a 5.74 percentage approximately, and the rate of 1 crore is given for the next 4 years. There is opening amount is 1 crore, rate of pay is 5.74 percentage, closing amount is, and on this 5.54 6 crores 1.1. So I don't know, calculating that is done in that full scale calculator. How in the case of calculation has been taken the AR exact 5.74%, that is the difference of the view amount of responding entity shall apply the requirement of this 109, and NDA is 20 NDA is 20 retrospectively any of the government loan oriented before the date of transaction of NDAs, provided that the information need to be done. According with the loans, optional exemption from the retrospective application of NDA's business combination. NDA's 103 need not be applied in the business combination before the date of transaction, but the one business combination is restated to comply with NDA's 103. All subsequent business combinations stated when the exemption is used. There won't be any change in the classification of gap. For example, the pooling of interest method is applied in India is 14. The balance of assets and liability arising thereof therefrom shall be carried forward. For example, regarding the identification of the acquirer, irrespective of the fact that business combination would have been a reverse acquisition as per India is 103, the accounting adaptation of previous years shall be continued. Recognize exemption. The table summarizes the provision of the paragraph C4 and 101. Case asset liability recognized in previous gap. Assets and liability qualifies recognized in days. Is there a change in intangible asset? The result whether the asset or liability recognized in opening in days. How the resulting change? No. So assets and liability recognized in previous gap, no. Then assets and qualified recognition, yes. It is the change in the intangible asset, no. Result whether the asset is liability recognized in opening in days, yes. How the resulting change accounted earning, retained earning. Assets and liability recognized in previous gap, no. Assets and liability qualified recognition, yes. It's the change in intangible, yes. And result whether the assets and liability recognized in the opening evaluation, yes. How the resulting change in goodwill, if the assets and liability recognized in previous year, yes. And the assets and liability qualify for recognition of NDAs, no. Is a change in the intangible asset, yes. The result whether the assets and liability asset or liability recognized in the opening of NDAs balance sheet, no. How the resulting change accounting goodwill, including any result change in deferred tax and using assets and liability recognized in previous gap anyways, and assets and liability qualified for recognized in days, no. Is there a change in intangible asset, no. Whether the assets and liability recognized opening in days balance sheet, no. How the resulting change accounting for retained earning, including any resulting change and deferred tax and non-controlling interest. Measurement exemption, if the asset is acquired or a liability assumed or not recognized in previous gap but would be recognized in NDAs, and they shall not have an deemed cost zero. Measurement of exemption, if an asset or liability assumed was not recognized in previous gap but would have been recognized in NDAs, it shall not have deemed the cost of zero, shall be measured the amount at which NDAs would require to be measured. The resulting change is recorded in the retained earning. If an asset is acquired or acquired a liability assumed was recognized in the previous gap, but the NDAs would require to subsequent measure another original cost. For example, investment certain equity instrument as 198 shall be measured on the basis or not on the original cost. This result change in recognized return earning. Example 5 below. In other cases, non-measurement of adjustment shall be made to the carrying amount of the assets acquired in the liability assumed. Therefore, it would be evidence of the balances of goodwill and capital relevant requirement of GAAP and such adjustment and the reason other than that recognition of intangible assets that is earlier submit to the goodwill and capital reserve of NDAs required to be recognized separately. The vice versa, the asset has been recognized as an intangible asset under the previous GAAP but is not removed to be recognized as an asset under the NDAs. Regardless of whether there is an indicator that goodwill may be impaired, the goodwill has to be tested and impaired on the date of transition of NDAs and other resulting of impairment loss to be recognized and returned earning or for the requirement by the NDA 36 equivalent relevant surplus. The impairment test is the result of the condition of the date of transition of NDAs. If an acquirer had not accordance with the previous GAAP capitalized the lease acquired in the past business combination, it has acquiring as leasing. Each shall capitalize this leasing in the consolidated financial statement as NDA 16 would require the acquirer to do in the NDA's balance sheet. Similarly, the acquirer had not, in accordance with the previous GAAP, recognized a contingent liability that still exists on the date of transition of NDAs. Acquirer shall recognize this contingent liability on the date unless NDAs would prohibit the recognition of financial statement and acquiring. The discussion of the chapter on consolidation not requires entity to consolidate based on the assessment of control. Assessment has sometimes resulted in consolidated entity that would not consolidate the gaps of GAAP financial statement. Let us understand the implication of this content of the first NDA's financial statement and illustrated. Illustration 105. A Limited has more than certain investment. B Limited and the conventional debt instrument than the conversion right to subsequent right of using B Limited and the control over B Limited. A Limited has evaluated A Limited, B Limited that would be treated as an subsidiary under the NDAs and hence would be required consolidated NDAs consolidated financial statement. B Limited would not consider as a subsidiary associated and joint venture under GAAP. How should B Limited consolidate a transaction of NDAs and assume that A Limited has adopted to avail the exemption of retrospective restatement of past business combinations? NDAs will not prescribe the optional exemption of retrospective and relation to the past business combination. NDAs 1% that when the past business combination is not restated and the present entity had not consolidated entity as subsidiary considering the previous year. Either percentage is not regulated as the subsidiary is not consolidated as a statement not acquired as in the previous year, and the subsidiary assets and liabilities should be included in the plan opening consolidated statement. The value of it appears in the subsidiary balance statement in the subsidiary of the NDAs and the parent data transaction. All this purpose, the subsidiary's separate financial statement should be reported as if the first time adopted NDAs after applying the financial time adopting mandatory exemption or voluntary exemption. In other words, parent will adjust the carrying amount of subsidiary assets and liability to the amount that the NDAs would acquire the subsidiary balance sheet. The cost of goodwill equal to the difference in the date of transaction between the parent interest at this adjusted carrying amount. The cost of the parent separate financial statements of the institute investment subsidiaries. The measurement of non-controlling interest and deferred tax follows the measurement of other assets and liability. It may be noted that when the above exemption is available, only the parent, accordance with the previous year, has not presented consolidated financial statement as the previous year. There is an consolidation financial statement prepared according to the previous GAAP, but the entity has not treated the subsidiary associate joint venture under the previous GAAP. Illustration: A Limited is subsidiary with B Limited first adoption NDAs of Y B Limited is exemption not restored in the past day of business combination. However, A Limited is consolidated financial statement has decided to restate all past business combination where the amount is recorded in subsidiaries need to be adjusted while the prepared consolidated financial statement A Limited is considering A Limited does not avail the business combination exemption. Will answer the difference A Limited and operating NDAs after B Limited. As per the NDAs 1, first time adopter has elected not to apply NDAs 1 or 3 retrospectively. The past business combination NDA business combination that occurs before the date of transition of NDAs. However, the first time adopter restates any business combination to comply with NDAs 1 or 3 and shall restate all business combination and shall also apply the NDAs 1 or 2 on the same date. For example, the first time adopter elects to restate the business combination that occurs on 30th June and shall restate the business combinations that occurs between 30th June date of transition NDAs shall also apply in India's 1 to from the region. Based upon the above limited three states past business combination, you would have to apply the all business combination of the group, including the by its subsidiary, be limited for the purpose of consolidated financial statement. The NDA is one not one state. However, if the entity becomes a first-time operator later than the subsidiary, associate, and joint venture entity share into the consolidated financial statement measure the assets and liability of the subsidiary and joint venture the same carrying amount as a financial statement. A subsidiary, associate, or joint venture after understanding the consolidated entities accounting adjustment for the effect of a business combination is the entity acquired by a subsidiary. Thus, the case where the parent adopted entity is later than the subsidiary. For example, if the parent is a non-banking financial company and the subsidiary is a trading manufacturing company, then it does not change the account already recognized subsidiary. Insurance contrary NDAs were not one shall apply the annual projects beginning and the end of the data transition of NDAs and if the insurance charges accounting policy for insurance liability is permitted to reclassify the same on all subsidiaries of PVTC fair value through profit and loss. Share-based payment for transaction. The first time order to encourage but not are required to apply NDAs or not share-based payments to equity instrument that vested before the date of transaction of NDAs. However, the first time order may apply to NDAs or not one entity equity instrument. It has disclosed publicly the fair value of its equity instrument determines at the measurement date. It encourages to apply NDAs or not more to a liability arising the share-based payment and transaction that is settled before the date of transaction NDAs. X Limited is the first time out of NDS one and the date of transaction is 1st April as given stock option to the employee out of 75 option as vested in November and our money 120 is vested in November 21. And what is the option available next to the time of transaction that India is one provision first time adopters encouraged but not required to apply the one not to share based payment to equity instrument vesting before the date of transaction of India is one. However, the first time adopters elect to apply one or to show that the equity instrument it may do only in the equity has disclosed publicly the fair value of those equity instrument, determining the measurement date and define days 1 or 2. And how having their have regards to about exclamated above options. The 75 options vested before the date of transaction to apply in days 1 or 2 and account of the same according provided it has disclosed publicly the fair value of the equity instrument, determining the measurement date of defined in days 1 or 2, not to apply in days 1 or 2. However, the all grant and equity instrument to which India's 1 or 2 has not been applied. The equity instrument vested but not settled before the date of transition to the NDAs would be still to be disclosed information. NDA for 105 option that will be vested for the date of transaction X Limited need to account the same as per India's 1 or 2. Deemed because of PPE intangible assets or right to assets. Entity has the following option that right to measurement of the property, plant and equipment and intangible asset and right to NDAs 38 and a right to use asset NDAs 106 in the opening of the NDAs measurement basis as per the retrospective standard applied retrospectively. The measurement option can be applied on the item basis. For example, plant A can be measured applied to NDA 16 retrospectively. NDA 16 can be measured applying the fair value revaluation obligation. The fair value of the date of transaction NDAs measurement option can be applied at the time to time basis on the similar fashion explained above. Previous gap revaluation. If the revaluation was a date of revaluation, probably measured on the fair value, the cost of depreciation, cost acquired, and other NDAs adjusted reflecting the changes in the general specific price indication. This measured option can be applied in the item by item basis in the world fashion explained above. Previous gap carrying amount provided the no change in function currency. The measurement option can be applied only if applied to all the asset classes, and thus therein applies the measurement option can be applied in investment property NDAs were not 40. Well, for investment property, India is 40. Investment property remains only to mod cost model. Therefore, the option to availing the fair value of deemed cost of investment property is not available for the first time adopters of India's financial asset. X Limited is a holding company of Y Limited. X Limited is required to adopt India's on April, and X Limited wants to avail the optional exemption to use previous gap carrying value in the respect of property equipment, where Y Limited want to use fair value of property, plant and equipment as a deemed cost on the date of transaction. Examine whether X can do so if consolidated financial statement also examine different entities and groups can use different bases of arriving in different deemed cost for plant, property, equipment, and respective standalone financial statement. Where there is no change in functional currency, the date of transmission of NDA is known at 9 and time taken adopt first time adopter as NDAs as elect to continue with the carrying value of all plant property equipment as the date of transaction measured as the previous gap as used deemed because of the date of transaction. After making necessary adjustment the first time adopter choosing the option to apply those selective basis of some of the item property plant equipment user fair value other than value. Nothing prevents the different entities with a group of choose different basis of arriving at deemed cost for standard financial statement. However, the consolidated financial statement the entity group shall be treated as a one reporting entity. According to treaty, it will not be permissible to use different basis of arriving at deemed cost of property, plant and equipment date of transaction of different entities in the group of purpose of preparing consolidated financial statement. Illustration 9 for purpose of deemed cost in the date of transaction, the entity has an option to use in the carrying value of deemed cost. In the context suggesting the carrying value of the consider the deemed cost, original cost or a book value. It is also examine whether there would be the impact on the future depreciation charges. As a result of deemed cost as a car date of transaction, the entity uses the carrying value deemed cost. It would consider the net book value on the date of transaction of deemed cost and bringing cost because carrying value has been net book value. The future depreciation cost will be based on the net book value and the remaining future value date of transaction. Further, as per the requirement of India 16, the depreciation method, residual value, and useful life need to be reviewed at least manually, and the result that the depreciation charge may not be the same as depreciation charge as per the previous gap. Illustration as was is it possible the entity to allocate cost as per the previous cap to the component based the fair value the date of transaction even when does not have component by historic cost. Yes, the entity has allocated the cost of the component based on the fair value of the date of transaction. This is permissible even when the entity does not have any component by historic cost. Illustration level revaluation under the previous gap to be consider the redeem the cost. It is the revaluation was in the date of revaluation broadly comparable fair value cost and depreciation cost of assets and assurance and NDAs. According to the reflect that there is a changes in general specific price index. What is acceptable time gap for the valuation of the cost of transaction can be adjusted and make effect of even subsequent revaluation. There is no specific guidelines to indicate one or two eliminating acceptable time gap such as evaluation from the data of transaction. The management of the entity need to exercise judgment in the regard of whether generally pay of 2 to 3 years may be treated as the acceptable time gap for evaluation from the date of transaction. As a case, adjustment shall be made to reflect the entire material event subsequent to this revaluation. Cumulative transaction difference. No need to recognize some transaction difference in the other comprehensive income. Reclassifying cumulative transaction differences for the foreign operation from entity to profit or loss or a part of gain or loss or disposal. If the first time adopter uses the exemption, the cumulative transaction difference is set to 0 for all the foreign operations. The gain or loss on subsequent disposal of foreign operations shall exclude this difference that arose between the transaction. The long-term foreign currency and monetary timing. The paragraph 46 and 11 notify that companies accounting standards rules 2006 permitted companies to recognize a foreign currency exchange gain and loss arising on the long-term foreign currency monetary items in either and following way. In a profit or loss in such monetary items entered into the acquired property, plant and equipment, intangible asset and the cost therein. If such monetary items are entered into for any other purpose, accumulated a foreign currency monetary item, transaction difference accounting FCMITDA. The first time adopter may continue the accounting policy adopted for the accounting for the actual differences arising from the long-term foreign currency monetary items recognized in the financial statement for the period ending immediate before the beginning of the financial India's financial reporting period as per the previous cap. To be clear, exemption is not a permanent exemption for the requirement of India's 21 available only to the long-term financial current monetary item which is recognized before the first India's reporting period begin. For example, the transaction on the date of 1st April 2025, the first reporting period is 1st April 2026 and 31st March 2027. Therefore, the exemption is available only if such exemption the monetary items are recognized in the previous gap and the financial items of the year ended 31st 2016. Y Limited is the first time not Y Limited. The date of transaction of April 1. On the date of the transaction, there is a long-term foreign currency monetary liability of 16 crores, 110 million converted to exchange of 2160. Accounting exchange difference in the date and there's Y Limited is followed in India's 11 notify under the companies of accounting 11 accounting 2017 has the not exercise option to provide paragraph 46 40 of IAS 11. Company want to avail the option under the paragraph IAS 11 to prospective retrospective the date of India's would you account the transaction difference in respect of the items around us? India's 101 provides that the first time adopter may continue the policy adopted for the accounting for the exchange of difference arising from the translation of long-term foreign currency monetary item recognized in the foreign statement for the period ending immediately before the beginning of the first India's financial period as per the previous gap. If the company want to avail the option prospectively, the company cannot avail the exemption until given the India's 101 and cannot exercise the option of paragraph India's 11 prospectively as the date of transaction of India's 11. India's is present in the long-term foreign currency monetary liability exists in the date of transaction as a company has not availed the option under the paragraph 45 46 and therefore the company need to recognize exchange difference in the accordance with the requirement of India's 21. The effect of change in the foreign exchange rate requires the foreign exchange difference to be recognized in profit and loss except the foreign exchange difference would be accounted for the adjustment of borrowing costs in accordance with the India's 23. If the company want to avail the option retrospectively, the company cannot avail the exception given in India's 101 and cannot exercise the option in the paragraph 46 of India's 11 retrospectively the date of transaction of India's respect to the long-term foreign currency monetary liability and access on the date of transaction since the option is available only if the continuously for the accounting policy followed in accordance with the previously gap yet he has not given the option therefore para 46 47 hence it will not be permitted to use the option given for India's 101 retrospectively. Illustration 7. Why Limited is the first time of India is a date of transaction April 1 2015 April obtaining 7 years $1 million loan which is exercised the option providing paragraph 46 40 of India's 11 has been amortized the exchange difference in respect of the loan over the balance period of such a loan over the period of transaction the company wants to continue the same difference whereas a company is permitted to do so. India's 101 provides that first time adopters may continue the policy adopted for accounting for exchange difference arising from translation of long-term foreign currency monitoring items recognized in the foreign current statement financial statement for the period ending immediately before the beginning of the first India's financial reporting period as per the previous gap. In the view of the above, the companies continue to follow the existing accounting policy and amortize excise difference in respect of the loan over the balance period and long-term intermediary investment subsidiary joint venture and India's 21 measure investment subsidiary joint venture and associated in the cost and workload of India's 101 fair value either through other comprehensive income or through profit and loss. India's 101 permits first time adopted to measure the investment and the cost determined according to the India's 27 above are deemed as fair value data transaction and previous gap carrying amount data transaction. Illustration about A Limited acquire B Limited business company transaction. A Limited agrees to pay certain contingent liability. Liability class in B Limited part of the investment in the separate financial assembly. A Limited don't recognize the amount contingent consideration since there is no consider probability. A Limited consider previous gap carrying the amount of investment in the team because of first time allocation. In this case, there's the amount carrying amount of investment required to be adjusted in the transaction. Solution in accordance with the NDAs 101, an entity has to treat the previous gap carrying value as to date of transaction investment subsidiary associated to date of venues. Subsidiary associated with point values are deemed cost evaluation areas. If such examples are adopted, then the carrying value of such investment is not adjusted. Accordingly, any adjustment is rendered or recognized consolidated after consideration first time adoption shall be made profit and loss account. Compound financial instrument. The first time adopter need not split the compound financial instrument into separate financial and equity component. The liability component is not outsourcing as a transition date. Illustration April 2021 Sigma Limited issue 30,006% convertible debentures face value 100 debenture per year. The debenture were redeemable by 10% at March 2625 as there is convertible to ordinary shares and the option of the holder. The interest rate of equivalent debenture without conversion right was by 10% rate of transaction. Suggestion how should Sigma account this compound financial instrument the date of transaction the present value of one receipt at the end of each year. 6%, 10%, end of year 6%, and 1.94, 191, 2.86, 384, 754 as 0.6. Carrying value of debenture on the date of transaction under the previous gap. Assume that the interest accrued from the premium redemption has been paid. That is the 30,100 into 1 by 10 by 2 by 4. 31 lakhs. 50,000. The premium payable on the redemption is paid according to the borrowing cost and under the previous gap on straight line basis. As per the D18 of the NDAs 101, NDAs 32 financial instrument presentation requires the entity to split the compounding financial instrument the inception of the financial separate liability and equity component. If the liability component is no longer outstanding, the transfer application of the NDAs 31 is involved separating the two portion equity. The first portion is recognized as the retaining and earning respectively cumulative interest assumed on the liability component. The other portion represents the original equity component. However, its accordance with the NDAs, the first time adoption need to be separated as two portions of the liability component no longer outstanding at the date of transaction of NDAs. In the first case, since the liability is outstanding on the date of transaction, Sigma Limited need to split the convertible debenture into a debit and equal portion of the date of transaction. According to the first measurement, liability component accord discontinue the contractual determine the stream of future cash flow and the present value using the discount rate of 10% annum, being the market interest rate of similar debentures, no conventional option. The interest payment of the debenture 6% plus per year. 1 to 4 is 6 into 3.5 is 119.5. The present value of principal repayment is 110 into 6.68 is 74 point. Total liability is 93. 74 plus total component structure is balance is below 6.18 vice value debenture is 100 total 30,000 31 is 1,80,000. The total debenture is 93 is 28.5. The data initial debenture has been amount of debt is 1 equity is 1,90,000. This is data transaction 4060 let's say you have to be a year one opening balance transfer cost 10% interest pay 180,000 closing balance is and 2% therefore the transaction is Sigma shall recognize the carrying value convertible to the 30,000 and recognize the equity component of financial year 180,000 the debit of it so it will equity component recognize asset liability gap. fair value measured with financial loss or financial liability. NDAs are not the fair value of financial loss or financial liability. Initial recognition differs between the transfer pricing, and it has not been available one for NDAs. Typically, has been one of the data also one of the difference in mortgage costs and loss of different statement. NDAs not one permits entity to apply requires of NDAs not one prospective local transaction entered into after the data transaction. Decomposition of liability including public appendix B, change in existing decomposition or restoration similar liability requires specific changes in decomposition, restoration similar liability, and reduction in cost of asset as a writer and adjustment in the reparation amount of assets and depletion respectively over the useful life. Entity need not complete the requirement of change in the assets and liability. Transaction equity against exemption from the settlement liability in the transaction rate of NDA subtraction based on the quantum risk adjusted rate and provision rate. The liability is called for bundle exceeding NDAs and rollback liability. Data liability using one of the best estimate of historical risk adjusted discount rate including the data possible by calculating the accounting depreciation and transaction data the pieces of estimate useful like the designation previous recognized financial instrument initial measured the financial value recording subsequent measure of DS9 permanent to upon initial recognition for an estimate upon designation financial investment and subsequent measure of fair value getting criteria. NDAs will not exempt the entity from retrospective designation of financial investment upon the use of designation to make the basis of the consequences. This exists in the data transition NDAs particular exemption provide the mentioned financial instrument designation of any financial liability assets of fair value through performance designation of investment of the entity instrument of fair value through the comprehensive income extinguishing of financial liability by equity investment. Operating India model provides a principle to populate when the entity equity instrument was issued extensible all part of financial liability. The person may the appendix NDAs were not meant for the data transition of NDAs. Severe hyperinflation combination entity data transition NDAs on the after hypercurrency normalized state in the assets and liabilities after function currency normalized data in the measurement of fair value data transition. As a fair value is the order deemed cost and asset and liability to operating. The function currency normalized date falls within the 12-month component only period. The company is period less than 12 months provide the complete set of financial statement provider of short-term liabilities. The customer of time may determine whether the arrangement is in the date of transaction NDAs entered in the list, including classification of lease or each land and building elements of the financial operation list based on the factor of convenience and access to the data of transaction. Lease, which is the first time marketing NDAs and recognize the lease liability, the right of use of assets, applying the following approach among the lease and data transaction, measuring the lease liability present value of the remaining lease payment, discounting using the lease incremental borrowing rate and data transaction NDAs, measuring the right to use asset of the lease and lease the right. Carrying the amount of NDAs margin has been applied since the commencement of data lease, but is continuing using the lease incremental borrowing rate at the data transaction NDAs or NDAs. An amount equal to the lease liability adjusted the amount of the applied amount of incurring the lease payments relating to the lease recognition balance sheet immediately before the transaction NDAs. Applying the NDAs also is the right to use of the first time modification of the lease may be done one or more of the following data transaction NDAs. Applying the lease by lease basis, applying the single discount rate of portfolio by lease and reasonable similar categories of elect not to apply the above requirement of NDAs A to C in the lease which is lease in 12 months and the date of transaction of NDAs. And then the list of instead of entity shall account for including disclosure of information about the lease as if the short-term lease accounted for NDA 16. India Act not apply the requirement of NDA A to C. The lease which is underlying the stay asset the value instead of the entity shall account for including disclosure information and the lease is as per NDA 16. Exclude the direct cost from the measurement of direct use of asset. The transaction of NDAs use hindsight use determine the lease in the contract contain option to extend and determine the lease. Financial asset, intangible asset, accordance with applicability of India's 115 service concession arrangement law. A case of accounting policy pursuant to the requirement of appendix to the accountant retrospective accept the amortization policy of intangible asset relating to relating relation to the tolling roads adaptation in the previous year. Practical for the operable supply requirement of NDAs are prospective at the date of transaction NDAs. We shall recognize financial asset and tangible assets that is accepted on the date of transaction NDAs using the previous carrying amount. The designation of contraction to buy and sell non-financial item. NDAs 109 pertains to contraction to buy and sell non-financial item to designate an inception a right to fair value through profit and loss sale. 2.5 NDAs 100 designation. The requirement of entity to pertain to designate at the date of transaction NDAs contained to the already exist on the date of measure of the fair value to profit and loss, but only they meet the requirement of paragraph 2.5 NDAs 109 the date of entity designate similar contract. Stripping cost of proceeding to fair minds the task time adaptation of value of appendix B NDAs noting stripping cost of production phases phased month the date of transaction of NDAs or the transaction day NDAs may previous recordings asset balance and result of stripping activity undertaken during the proceeding phase shall be reclassified as a part of existing asset which is stripping activity rated as the extent of that the remaining identified components of over body which is the predecessor of a stripping asset are non-current asset held for sale and discontinued operation in the first time taken as a non-current asset that is a sale and discontinued operation the lower the carrying value far or less cost sell the date of transaction increase and the potential the increase on the condition direct retaining earning of the difference between amount that is carrying amount and the asset and the date of transaction of India is retaining for the entity's previous cap assets and liabilities subsidiary subsidiary became first time after later and the subsidiary shall be matured assets and liability either the carrying amount would be included parent associated consolidated financial statement based on the parent date of transaction in DAs and the carrying amount classifies in DAs based on the subsidiary's date of transaction. If the entity became first and out to later and subsidiary entity shall mature then assets and liabilities of subsidiary the date maturing as a financial statement subsidiary after testing consolidated entities according to testing as on the effect of maturing combination with the entity acquired the subsidiary.